Aloha, everyone. Before we get into the new positions, I want to make it very clear I am not bullish here at all. I'm very bearish, actually, short term. Ever since the August lows, the uptrend started out okay, but starting right about here, this pullback should have probably have reached around this 247 level right here, 246.80 level right here, to have been considered a good little pullback for the continuation of the uptrend. Instead, you can see how shallow it was. We raced higher and then no pullback, and then once again a pullback started. But for that to have been a healthy pullback, we probably needed to go down to 250 level. Didn't happen. Race higher, pulled back. For that one to be healthy, probably would have needed to retest the 253 level in the SP 500. Instead, another V-shaped rally, a pullback, can't even make it to the last pivot point area, and then another move higher, another V-shaped move higher. The V-shaped moves, everyone, is not healthy. Even though the market has moved up from the August lows, this looks like a good uptrend to the amateur eyes, but to seasoned professionals, this is wrong. This is very unhealthy, and uptrends like this eventually lead to a big crack and a correction, sometimes erasing almost all of the recent gains. So I want to make it very clear. I am short-term very bearish here. I've had way too many signals. They've been churning around way too much. Now, overall, a lot are doing better than the ones that are failing, and the ones that are failing are hitting my tight stops, and I'm having very small losses. But it's a lot of churning. It's a lot of commissions. It's a lot of trading, and it's indicated to me that something is wrong here. Very, very wrong, especially in a seasonally bullish period. And now we have the RSI index up here rolling back down from overbought levels. We're not even close to the 50 level, or much less oversold like we were in August. So, which we actually didn't even get oversold in August on the S&P 500, but we did on other indexes. So the bottom line is this is not a healthy tape. And if we go and look at the NASDAQ, similar situation here. That V-shape move higher, V-shape higher, V-shape higher, V-shape higher. It looks like now we can probably roll over again, and once again nowhere near oversold levels, and this index hasn't even really gotten oversold since the summer. So another bad looking index, but the worst one of them all, and the most important one to me, the Russell 2000. This thing, after getting overbought back here, it pulled back, but once again, it came close, but didn't test that pivot point level. And look at that V-shaped move higher. I mean, folks, while this looks good and is good if you're long here, if you want the big, juicy, huge returns where you hold a position for multiple days, weeks, months, and then realize 100, 200, 300% gains, they do not come from markets that move like this. V ramp up, pull back, V ramp up, another harsh pullback. At least this time after the V ramp up, we've come back into the consolidation area, but now that even makes it more sketchy, as now it appears that we have a shoulder, a head, and we might possibly form another shoulder. It already looks like the RSI index is ready to roll over. MACD and histograms rolling over. So if anything, I would expect this low to be taken out. And if it does get taken out, expect these lows to come into play. Ultimately, the 200-day moving average. I don't like how the market looks. I don't like that I saw the IBD put call hit new 52 weeks low yesterday. I don't like that everybody is asking me about Bitcoin. I don't like that everybody wants to get involved with the market. And I just don't like the action in a lot of individual stocks. With that being said, it's not terrible yet, and there's still a lot of good patterns out there. But this evening, all I got were hedges. I got two ad signals in long positions, but actually let's go and go over those first. The first one is SPAR. SPAR is can, slim, and perfect speculator quality. That's why it's a new long. Also, volume much higher after a low volume consolidation and BOP increase over the day before. To go long stocks now, I need total confirmation. BOP's got to rise from the session before. Volume's got to be higher than the session before. Candle over candle. SPAR's got that, so I'm going long SPAR. Limit order 1565. First cut loss level 1550. Final cut loss level on this ad signal, 1440. Move below 1440, I'll be out of all of my ad signal. I'm already long this stock from right here. This is right now my final cut loss level, and it's going to stay that way for now unless it starts to fail below the 50-day moving average and heavier volume. But I really like SPAR. Cancel perfect speculator quality would normally be 4%. It's an ad signal, so it's 2%. So it's still 2%. So SPAR, a really good signal on a session like today. Hopefully it can buck the trend. There's some mandate going in effect on the 16th that I think that all these automotive stocks are running into, including one that we're long that's currently under a pump, SRI. So it'll be interesting to see how that plays out. HEI is the other new long signal. Once again, candle over candle, bullish hammer candle over candle, above average volume, and BOP rose. What I don't like is it's been up like 1 trillion days in a row. I like to exaggerate. And so that's a little problematic, but using a disciplined methodology, getting the stock with the limit order, the high day 92.13 because the 20-day moving average is touching the lows 90.55, and then using this level as your first cut loss level 89.51. This level is either your final cut loss level or your second cut loss level 88.26, and then no matter what, not holding the stock if it moves below 86.61. It seems like it's a pretty decent play in a weak market, especially since it's aerospace and defense. It's basically a safety stock, just like SPAR is. It's an automotive stock. Automotive and aerospace defense stocks do well in poor market environments, and if we do switch to a poor market environment, it is very possible that these two can buck the trend, especially with these very nice green patterns that they both have. But those are the only two new long positions. HEI is only canceling quality. Since it's not extended, it's only halved to 1%. If it was extended, it would be 0.5%. But since it's not extended, 1% for being an ad signal canceling quality. And then for hedges, EWV, huge volume surge. So right here, I want to go ahead and hedge using this one. Limited order 26.93, one and only cut loss level. The lows here 26.47, the 52-week lows. Also EEV, taking out that 50-day moving average, closing at the high of the day. A little harder to see here. There, that's easier. Limit order 902. My only cut loss level moved below the lows, 838. I'm going to give it room to back and fill and work. And remember, all hedges from now on are being played like I play my VIX hedges. So if I buy 100 shares here, it moves below this low, I'm out 50. I'll have 50 left. Whatever the next day low a day is, right below that level, 25 shares. If it fails and those 25 shares go, the next day's low a day, 13 shares. Next day's low a day, if it fails, 7 shares. Next day's low a day, 4, then 2, then 1, then 0. And that's how I'm playing these hedges, as long as this market wants to do this stupid V-shape, low volume, shallow, low VIX moves higher without any real pullback in the market. Like I said, that move off the August lows, the V-shaped move, I didn't mind. I wish we could have ebbed and flowed, and by ebb and flow I mean go up, sideways, up, sideways, up, sideways, up, sideways, up, sideways in a symmetrical manner. Since we didn't, here we are. But that move here was fine with me because we did it from near oversold and oversold overall conditions in many stocks. This time around, it's different. So, ad signals, TECS, this one's pretty crystal clear. Limit order 694. One and only stop still 673, those November lows. SPXU, SPXS, SH, whatever you want to do. SH is the prettiest one, but the most juice is SPXU. I took SPXS yesterday because SPXS finished higher than SPXU, but today SPXU had more juice than SPXS, so I'm picking SPXU as the hedge to take today. Limit order 1172, the one and only cut loss level 1145, and then the last ad signal SDOW, 0.5% of my account capital into this one. Limit order 2007, the one and only cut loss, same with yesterday's signal. 1970. It wasn't yesterday's signal, it's back here. I said I was knocked out a half and my cut loss level is 1969 and it tested 1970 today, so it didn't knock me out. I don't remember if I remember, as you can tell by just listening to my voice, I'm still sick. TECS, That's a 3% total because it was in 3 scans, but it's halved since it's an ad signal, 1.5%. SPXU, SH, SPXS showed up in 3 separate scans also, so that's also halved, so that's a 1.5% ad signal. But the hedges are priority. I see a lot of traders taking quote, quote, risky signals. Guys, if you're new and you're trading up here, you're not like me. I'm putting, so tonight, the 2% signals, I'm putting $8,000 into SPAR, and it's going to cost me $1. SDOW, I'm putting $2,000 into SDOW, and it's going to cost me $1. I don't care if I had 10 stops on this stock before it hits 1970. It doesn't cost me anything. I'm seeing traders in the chat room and in the comment section taking risky trades, and by risky trades I mean stocks that are extended from the 20-day moving average. Don't trade like me. I trade like me because I've lost my confidence in putting capital into any one position, so I treat all signals the same until everything lines up. Nothing is lined up for a very long time, since 2013. So until, that's insane, that's 4 years ago, and to be honest with you, nothing's lined up since the last uptrend in 2007. So it's been 10 years. So it's just the way that I trade because I'm capitalized with the commission cost. Stop trading like me. Take only safe signals. HEI is considered a safe signal, but really that's not even the safest signal because you don't see it touching all the moving averages. That means it's not safe. Don't take it. SPAR, that's different. You've got it at all the moving average, at least below the 10-day moving average, and you have it on the 50-day moving average, and you have multiple support levels. That's safe. Buying BPMC up here, away from the 50, away from the 10 and 20-day moving average from a gap, that's not safe unless you understand that it's going to probably fail and hit your stop. I don't want it to. I think when I look at a chart like this that it should zoom higher, but if it doesn't, guess who's not surprised? Me. But other traders now have just taken an 8% loss in this stock unnecessarily. You're not supposed to trade like me. Take only the safe trades. If you're only going long safe trades, SPAR is it. If you're going long only safe hedges, EWV is not it. EEV is not it. SPXU is it. SDOW is it. TECS is it, because the support levels are right there. There's no backing and filling needed before it hits that stop. Stop chasing if you're a new trader. Stop taking the risky signals. Only take the signals I deem safe, and realize that's a relative term to a market that I consider quote, quote, up here in the stratosphere from the 2009 lows. Guys, if we're going long stocks following a downturn like this, okay, look at this downtrend in 2009 and look at 2009 when we start to move up. You start getting long signals here after a pullback like this, that's one thing. When you're getting long signals up here in a market that's up from these lows like this, that's insanity. Trade safe, everyone. Don't try to be a hero. Don't try to press it. Cash is a position, and if you're a new trader, just knock it off until this market's oversold and we get high quality signals. I'm showing you and telling you exactly what I'm doing on my end. It doesn't mean you should too. Do your own due diligence. Think about your positions. Think about your capital. Think about everything being lined up. If sentiment was bearish across the board, we just had a 10% to 20% correction in the market, and then you see this chart pattern, and then you see this chart pattern, that's a totally different ball game. These then become 5-10% long signals, not 1-2% long signals.